Okay, good afternoon, everybody. Today is August 26th. It's Friday around 2 o'clock Pacific time. Market's closed. This is your weekly take on the market. I will be your host. My name is Scott St. Clair. I'm the manager of the Premium Product Group here at Investors Business Daily. I'm losing my voice a little bit, so I apologize. Hopefully, everyone can hear me okay. We will fight through it. This is the disclaimer. We're not licensed at IBD. We don't provide buy, sell, hold recommendations. Uh, our sweet spot, our circle of competence is education, research. So take a moment to read this. Okay, we'll talk about the market indices, the market overall. We'll do the industry groups. Not a lot going on there. I looked at it earlier. And then some stocks to watch. I actually have a handful of names there. There's a lot more going on in that kind of universe. And then the quote of the week. So a couple of charts that came across my desk. A lot of charts come across my desk. Substack, newsletters, Twitter, and I think I mentioned last week I like charts. I know you can manipulate a chart a little bit, but mostly a chart tells a great story. I thought this was interesting that the relative performance of emerging markets is all the way back to like 1998 Asian financial crisis levels. Just been a terrible place relative to the S&P to have your money. I've always thought that that's the. I think maybe because of when I started, you can see I started in late mid 90s. Look at the chart over there, how steep it was. So emerging markets were always a better place to be as far as performance. So maybe that's why I've always kind of gravitated to emerging markets. Every once in a while, I've done that. I've owned emerging markets in my 401k and in a mutual fund for the longest time. It's just been dead money. It just has not performed at all. And this chart proves what I've always what I've kind of felt along the way. There just hasn't been any reason to be there. The U.S. has been the best performing market for a long, long time. This is a very noisy chart, but it actually tells a very good story. This is performance of the bond market since 1990. So every one of those lines is an annual performance. And the key is you can see this year, 2022, how much of an outlier to the downside the bond market has been. And that's been the problem for the stock market is the bond market. It's been a really, really bad year in the bond market relative to normal historic performance. It'd be like the S&P being down 60% in a year or the NASDAQ being down 65% in a year. It's really just a huge, tremendous outlier. And that's been a problem for the market. And the overall market's done a pretty good job of shaking it off. But the average stock under the surface, as we're all well aware, has really had a tough year. There's a lot of stocks out there that are teetering. The upstarts, the firms, Peloton, Teladoc, it's they have had and then I've just named a few, not to pick on those companies, but they were great on the way up and they've been really, really bad on the way down. And the environment is not good for them. And some of them are trying to raise money, and it's a terrible environment to try to raise money as well. If you're listening or hearing, you can see there's that energy is a big problem. It's on everybody's radar. This is a chart of electricity prices in Germany and France, just parabolic. And you probably might have heard or seen the stories. Like I saw there was in China, a bunch of EV stations were turned off. You just can't even get power anywhere. Yeah, some nitrous fertilizer plants in Europe had to halt production because of electricity / natural gas prices. And I've seen some stories, of people where their electric bill was, 500 euros versus 100 last year. I feel like in the last, I've been in my home 20 some years. My electric bill is probably, I feel like it's almost tripled. It just keeps getting worse and worse, but it's like a frog boiling, right? It's been getting worse and worse slowly but surely versus I couldn't even imagine if my electric bill, went up fourfold in 16 months or something like that. It's just really, really a problem over there. I don't know how to play this, so to speak. I don't know how I can make money off of this type of trend, noticing this, because I've noticed this and I've tried with the liquid natural gas shippers, uranium, and I don't know how I could have, or if it was even possible just to buy this chart, because I'd have rather have done that, coming through 400. The good news is I feel like this chart's very parabolic, very climactic. And so if it is climactic, it's probably near the end. So hopefully they'll get some relief on those prices. But energy is on everybody's mind. It's everywhere and we need it. And so that's why the energy area, whether it's fertilizer stocks, which are starting to come alive again, or our natural gas stocks, which have been great performance this year, oil and gas, Oxy, Chevron, Exxon. It's been the one area that solar has done really well. It's the number one group. So you want to understand the macro but trade the micro. So I don't know how I would trade this, but you kind of want to have a broad idea of what's going on in the world to kind of build your narrative on how you're going to trade these stocks. Like I think like, well, what could get this stock to go up a lot? And also the other way around, like if I was in a lot of the natural gas shippers, but I have moved on. I've sold them all, and it's because I see this chart looks very climactic. If it's climactic, I think it's coming down. If it comes down, what happens to those stocks? I don't know for sure, but maybe they go down because they went up because of this. Did they? I don't know. So I think about that stuff and helps me to build my narrative for each of my ideas. Let's look at the industry groups before I get into the. I'm sorry. I meant the indexes before I get into the industry groups. So NASDAQ, really bad day today, just like right on the lows. The only thing that stopped the market from going down was the close. Every tick was lower. It was brutal all day long. The S&P, very similar, really bad day. I actually am kind of glad it's doing this. This is the shakeout that I'm looking for. I think this is a shakeout. I think this is a shakeout for a move higher. I don't know. I'm going to wait for the move higher before I start to position. But I just feel like this is what the market needed. If you're bullish, it'd be very hard to stay bullish today. I know it was very hard for me to stay with some of my positions, even though they weren't doing anything poorly. Some of the names, you feel the heat from the market going down tick by tick by tick. It's like, oh, maybe I ought to get out of these before they start to go down. So you've got kind of this upper trend line, and this one was broken. That was steep. That one broke. So maybe it comes down and tests here. We'll see. We'll see. I'm not certain it's a leg lower, but what makes me think that is that the bond market didn't do a whole lot. So here's the proxy for the 30-year. If the market, if big money was really worried about interest rates going higher, because that was kind of the catalyst for today's sell-off, why didn't bonds go down? They should go down, right? If you think interest rates are going to 4%, you should sell your 3 or 3.5% coupon bond and wait and buy the 4%. And if your sovereign wealth fund or CalSTRS or CalPERS, a pension fund, it's incredible how much money you can save and or make in a difference like that. You think, oh, it's only 0.5%. Well, what's 0.5% on 3.5? um, that a lot, and the amount of money that that you would make from that type of move, right? When you're managing billions. So this gives me pause that maybe, I don't know. We'll see. I'm not. I don't want to be like way out there in case I'm wrong. I do own a couple of stocks I'm long. I also am short some stuff that I think is in trouble. But I'm net long, if that makes sense. I have much more exposure to the long side. But the stuff that I'm long is not, I don't want to be long anything NASDAQ related, especially big cap NASDAQ. And maybe in stocks to watch, I'll talk about that. But uh, Apple, Nvidia, Google, just avoids to me. Maybe I can go down that rabbit hole a little bit in stocks to watch. So, but let's see. We'll see. I don't know. I never know. You've got this trend line here. You've got this one, which is broken. I think for me to get really bullish, I would love to see it open lower on Monday, some kind of hammer like that, and then maybe like that. And that would tell me that this was just a shakeout, a fake out to the downside. So I don't have to be the first one in. I'll wait and look for some type of shakeout like that. If it just keeps going, then I'm just gonna stay out until it does something. I don't know what IBD is going to do. I would assume they're going to go to uptrend under pressure. We'll find out real bit, but that would be a real big surprise to me if they don't change that. Okay, so industry groups. Oh, I know I wanted to talk about. Oops, 0TNX. Okay, this is the yield. This is the opposite of the bond market. And this has been the problem for stocks. Look at this pattern. Look at this amazing breakout right there out of this really big cup with handle, or, if you want to do this one or this double bottom, broke out, ran, pulled back to buy point, ran again. And, honestly, it looks pretty constructive here. You have the potential for kind of another double bottom here. And if this is going higher, that means yields are going higher, stocks are going lower. It just is what it is. It's just going to be really hard for the market to shake that off. Excuse me. If I go to the weekly, you can see the big move that it's made off the bottom. This is, I'm going to go to the monthly. It bottomed at 4 and it topped at 32, eightfold move. Now, from a kind of crazy low level, 0% interest rates across the globe, et cetera, but eightfold move, just impossible for the market to shake that off. And so, yields have been higher in the 90s, but it's been a long time. I think since I think a friend of mine who was to kind of walked me through this and talked a lot about it. He follows this very closely, and he was saying since 2007. So his number is like 4%. That's kind of like, to him, it's like a magic level, and you can see that's roughly 4%, where the 10-year has not been above 4% since pre-great financial crisis. So if we get 3.5, you get like a little breakout here, 3.6, 3.7, 3.8. You're just going to have to be out of stocks. It's just going to be too hard for the market to overcome that type of action. Think about, I think the world bond markets are, I don't know, 10-fold at least, the equity markets, sovereign wealth funds, pension funds, they have trillions to park, and they park it in these bond markets. So the big boys vote with their big money, and so they didn't do a lot of voting today. It was super quiet in the bond market from a relative standpoint versus what the equities did. Equities did not act. Equities just threw up all over themselves all day, and the bond market just sat there. One of them is quote unquote right. I don't know which one it is. I guess we'll find out. But one of them is right. One of them is wrong. Okay, industry groups. I'm not going to spend a lot of time here, to be honest with you, because I looked at it. It's very similar. Energy, solar, oil and gas, royalty, biotech. 1, 2, 3. Same. I think I did. The only one that kind of jumped out at me was I can't even remember now. There was one that it made a big move, but there really wasn't a whole lot in that group to get excited about. But I will go through this weekend, and here's the routine. It's 3 months ago, last week, current. Let's just talk about energy solar. 3 months ago is a turkey, worst of the worst, 176 and 197. How did it get from 176 to 1? It just didn't show up at 1 one day. It went 176, 145, 121, 80, 50, 12. You get the idea. Be there when it's doing that. 80, 50, 12. You want to be on top of it and be aware of those stocks. So you can catch Enphase or Solar Edge or First Solar or Ray or whatever the stock is that you think might be the leader, rather than by the time it's number one, it's too late. So it's an important exercise, and it doesn't take you a lot of work because once you've done it, you're ready. You know that group inside and out. You don't have to do it the same group week by week. Industry groups, stocks to watch, and then we'll do the quote. Where did my markers go? There we go. I'm going to turn my camera off while we go through the stocks to watch, give you guys a better look at the whole stock chart. So CF breaking out of a base was up today. Market had a terrible day, was up. Wouldn't it be nice to always have stocks like this? I do own CF. And like I said, it was one of the stocks that I was like, oh, do I want to sell it? You know, how much pressure can it take while the market's going down tick by tick? It did nothing wrong. It's coming out of a long base. The relative strength's a new high. And, you know, this seemed a bit climactic in that. And you did get a correction. Stock corrected 30%, but it's shook that off and now it's breaking out. And, you know, I'm looking for this. You know, this is the kind of stocks I like to buy. Quarterly earnings and sales, huge, really great proprietary ratings. Let's open up the panel. Oh, well, what do you know? Fidelity Contra. March buys 1 million shares, starts his position, first time. June, 1.68 million shares, adds to the position. Interesting. Right? Interesting. This is what I want to see. If it's empty, that's fine. I do own NTR, which is in the same group. I think Fidelity's position is so small it shows up as a dash. But this is a bigger company. I think it's twice the market cap size as CF. Probably not going to move as much as CF, but I do own this one as well. There is another one in the group, UAN. I owned this one as well, but then I thought, I own three stocks in the same group. That's a bit much, especially in the market environment we're in. And why did I sell this one? It honestly, it was just a liquidity issue. This one trades a lot less volume than the others. It trades like $1 spread, sometimes more. And I just thought, if I decide one day I want out, which one's going to be the hardest one to get out of? It's going to be this one. So I moved on from this one. Now, if they all work great, this one will probably work the best because it's the smallest and, you know, harder to buy. So it works both ways, but that's okay. I'm more concerned with the risk than the reward at this point. it would really break my heart to see this stock at 200, because if that happened, I can only imagine where CF and NTR would be. So, this is good. I like to see that kind of ownership. Let's open this up, show fund ownership, and you can see my flags that I have for some Fidelity funds. And Fidelity has almost all their funds, well, on the gross, the ones that I follow anyways, have a position in this one. So that's a group that's holding up really well. Enphase Solar. This is a stock I have just not done very well in at all. The bars are it's just too hard to own. You see breakout fail. Oh, looks great. Pulls back. Gaps up, hits your stop before earnings. What are you going to do? Or breaks out, I should say. So I haven't had much luck, but I think the way I would buy Enphase is like this, some kind of weakness. I think that's the best way to buy it. And then if it broke above this, let's say, does that, and then everyone's going to be going crazy telling you that Enphase is breaking out, and that's where I'll be a seller. So that's how I would trade a stock like this. Array, I think, is in the same group. Looks okay. A little smaller, having a hard time getting going. I did own SHLS for a while, and it did okay. I bought it. I think I bought it that day just by luck that it gapped up here. You can see it just kind of stair stepped higher, but a lot of pink bars. It tends to be good one day and bad the next. And I knew the earnings were coming, so I moved aside. And the earnings weren't all that great, but the group is acting okay. ACLS breakout up 10% one day, down 11.5 the next. Not good action right there. GFS, you can see the little trend line I have here. So looks like a kind of a double bottom here, but I don't know about the group technology / big tech. Like I said, I think it's an avoid. So let's go to Apple. Not a good day today. This is the best of the bunch too, for sure, but not a good day for Apple. You can see it's actually RS line new high, so it's the best in breed, but I just think it's an avoid. Nvidia, look at the earnings and sales, just decelerating. I think even Apple is decelerating at 25.9 negative, 11.92. They're all, I think all of them are decelerating. 22.14.3, 2018.12. That's Microsoft. Amazon, not available, 9.77. Sales growth is anemic. So you have to understand what's an avoid. An avoid just means, don't go there. Doesn't mean you want to short it. If you own it, maybe you've owned it for a long time, that's fine too. I think at best it's a market perform. So Amazon, Microsoft, Apple, you're kind of just hoping the market goes up, because they're not going to give you that outperformance that they once did. History is against that happening. That's the main thing you want to think about is what does history say about after these stocks have made this big move? Microsoft was one of the few, sideways for a long time, then participated again. But Cisco, if you sold the top in 2000, you're pretty happy. You still have an incredible price, and you avoided all the carnage. Intel, here's 2000, nothing for 22 years. Stocks for the long run. So you haven't lost. Maybe you've captured a little bit of dividend, but you've missed the opportunity in other stocks. It's Oracle, 2000 top. Actually, a little better than I would have guessed. Oracle did, and some of these stocks don't exist anymore. But here's Juniper, hasn't sniffed those highs since 2000. So I think these are a little big and waterlogged. The Amazons, they're overowned, and I just don't see a lot of big upside from those names. All right, so the quote of the week. I was going to do a Julian Robertson quote. Maybe I will next week. Julian Robertson is one of the great hedge fund managers. He passed away a few days ago in his 80s, I believe. But if you've heard of the Tiger Cubs, they're all products of Julian Robertson. They worked with him. He seeds them, and they go off, and a lot of them have done really big things. So in his track record was very enviable. I think he closed his fund in 2000 because he just didn't get it right, and he was right, but he's early, and so he's buying stocks that weren't going up because he didn't believe in the bubble, and again, he was right, but being right and being early is sometimes can hurt you. So maybe I'll look for a Julian Robertson quote because that was sad news to hear about him. He was one of the great investors. But I think I chose. Oops, sorry. Ed Johnson, who is the founder of Fidelity. And there's been a couple of Ed Johnsons along the way, but this was I don't know if original Ed is the right one, but he was the founder of Fidelity. He says, I've been absorbed and immersed since 1924 in the market. And I know this is no science. It is an art form. It is a personal intuition, sensing patterns of behavior. So there's a lot of feel to what we do. We try to break it down into a science, try to make it a rules-based approach. What Bill would say is rules. There's a lot of rules out there. They keep you out of trouble. But sometimes it's just, you just have this intuition that something's either not right or the other way. Sometimes I feel I can sense, like with NTR and CF, bought those about 2 weeks ago, and I don't know, it's just something about the way they were acting. I could just tell they were going to go higher. Now, maybe I just got lucky. I don't know, but I just had this intuition. These stocks they're acting really strong. There's something they're doing in the face of the market, maybe, or something that tells me that these are buys. So as you get better at this and you absorb yourself in this, you'll start to trust your intuition a little bit more. Ed Sakota, an amazing investor, says you have to separate your intuition to your into wishing. So am I wishing for them to go higher, or is it my intuition that they're going to go higher? If you're already in something, then you have to, maybe it's your intuition. But if I don't have a position either way, and I get a sense of where prices are going, feel like that's my intuition based on all the observable hours I've had throughout my career, and I tend to trust my intuition. It's not going to be right all the time, but I tend to trust that. Okay, so next week we have the monthly webinar, me and Harold, on Thursday. So there will not be a take on the market on Friday of next week. Have a great weekend, everybody. Hopefully you can make it on Thursday to the event. If not, it'll be recorded. You can watch it at your convenience. MarketSmith@investors.com, 800-424-9033. Thank you, everybody. Bye-bye.